the home equity business, and we know that that business is poised for growth. And in a report on home equity business, TransUnion noted that they anticipated this segment to continue to gain momentum, basically doubling from a previous 5-year period to the current 5-year period we're in now. And I think I told you before, I believe so much in the second mortgage side that I left the first mortgage side, and very excited to be part of this. So it's really been established that your timing seems to be right more than it's wrong, and I haven't it's pretty well proven here. And you started your career at First Union Home Equity, and now you're an investor and a board member of this home equity company. And we can see based on your timing, and I'm just sharing a screen here with the idea of over the last 20 years, how equity has really grown here recently, JC, just so you see it, and the timing of starting Spring EQ. So I'm assuming that you had plenty of options to use your investment and business knowledge, but you chose home equity again, and maybe you could give us your thoughts on the second mortgage home equity and it's kind of re-emerging into the business.
Okay, well, I would give credit to Jerry Sciano. He's the one that came to me with the idea. So if this turns out that we're right, I'll take the credit. If it turns out we're wrong, I will blame Jerry.
Yeah, he said the same thing, I think. So
did he? That's not surprising. So I spent the first 12 years of my career from 84 to 96 working for First Union Home Equity Bank. So I'm probably more fond of the business than most because I spent a lot of time with it. And it's important to note that the first mortgage business that we're in today, especially the refinance business, is the refinance side. That's a rate-driven business. Now the purchase side is a need-driven business because people want a house, need a house, they get a purchase money. But the majority of the business today, which refinances, is a rate-driven business. It's important to know that the home equity business is a need-driven business. So what I used to find amazing back when I was doing this full time was you could refinance a mortgage for $200,000, and people were somewhat appreciative. You could make them a $30,000 second mortgage so they could build a pool, and they were ecstatic. They were ecstatic with you, even though one loan was significantly smaller than the other. So just important to throw that out there. And now, as people get locked into their first mortgages now, that this equity is in there, and people are going to access it. You look at the credit that's being accessed through personal loans, through credit cards, et cetera. That's all that business will trickle down through this channel, through the home equity space. And then there's a math play right now on a lot of loans. Use the term in the money with first, but there's also in the money with seconds. And seconds that make more sense to do as seconds when you combine the two mathematically than to do a refinance. Now, as an originator, if you can do a refinance, you can do it all day, do it because it's a bigger loan, it's one loan. But you want to be able to have a product there for when people mathematically it doesn't make sense or they want money faster. So as I look at this, I want to go back to, if you look at the market, it's been, again, I've said this earlier, it's been dormant for 10 years because of the historically low rates and the historically length of time that we've had low rates. So if I look at second mortgages, and I'm just going to keep this really simple. There was a time 3 years ago, I'll make an analogy, when 90% of the business was refinance and 10% was purchase. And companies got ahead of things, said, okay, this refinance thing can't last forever. We really need to focus on the purchase. And so the smarter originators are out there driving their purchase money business up as a hedge to when interest rates ultimately do change. Well, and some do it better than others. Well, I would make the same analogy for the home equity business. That there's three reasons to really look at this. One is it's a natural hedge to when the rate cycle does edge up, and nobody knows when it's going to happen. We all just know at some point it will, and it probably will during the careers of most people on this phone. So number one, it's smart to start now building those muscles so that you can transition successfully. The average size loan, and I'm not going to get into great specifics because I know Jerry Schiano and Todd Highfield are scheduled for a more tactical discussion later. But the average loan at Spring EQ is 55 to 60,000. So clearly it takes 3.5 of those to do a typical first. But the fees generated from it are equally good, and so it truly is it's a real revenue creating product. But the time to do it is the time to figure out the muscles is now. That's number one. Number two, it's a real opportunity right now because that sector is growing, and it's the revenue opportunities are there. I won't mention by name, but it's interesting. We've had one particular entity whose name I won't mention. One particular company that in one of their branches actually did 20 home equity loans. So they just started making it a part of what they do and found that when they tapped into the needs of somebody that either just closed on a house that they talked to before, that if you talk to somebody about a home equity loan, typically they've got excess credit out there with their credit cards, personal loans. They've got everybody's got seems like most people have a particular need if you just sat them down to talk to them. And so there is a burgeoning opportunity right now that's really being missed, particularly if you already have the person on the phone. So one, get ready to do it before revenues go down when rates go up. Two, it's a real opportunity right now. And then thirdly, it's a way to deliver one more product to a consumer that is going to be, you just had a first mortgage transaction with them. It's another way to do something for them to leave a lasting impression. Absolutely. And so with the non-solicitation elements in the market today, you want to give that customer one more reason to call you back. And so that is that's a great way to do that. So it's ancillary. Any way you look at it, it's ancillary, but it doesn't mean that it has to be immaterial. So we're all fighting, just like now originators have to compete with sub-servicers that are getting smarter. And so anything you can do to give one more product to your consumer, and I wouldn't just stop at home equity loans, anything you could do for them that gives them one more reason to remember you and thus call you back is always a smart thing to do. And I'll kind of tie this into the beginning of the discussion for folks who are owners of businesses on the phone, and for people on the phone who think they may want to start a business. When it comes time to sell a company, companies that have multiple lines of businesses prove that they can adapt to changing environments, prove that they can manage multiple product bases. Those are the companies that larger companies who are trying to bolt something onto their entity will look at. So I didn't say this earlier, but anytime you're building your company, there's two lenses you have to look through. One lens is what do I have to do to compete head to head in this market? Number two, what do I need to do in the design of my company that makes it easy for a larger company to bolt to want to acquire my company, and then thus what I've built becomes scalable within that entity. So if you look at example of that is, if you look at Decision One, when we sold to households, we were doing $100 million a month. Believe it or not, we were the largest non-bank supported entity at that time, which is why I sold it. And then after that, 5 years later, we were doing $2 billion a month. And it was because we built something that was scalable, but we had an idea what scalable was. If you look at when Jerry sold his company to AIG, same thing. His production went up fivefold in a matter of 3 years because he built a scalable company that could manage, more than one product. So just important to be able to keep that in mind.
Outstanding. Anything else you want to add to that? Because we can open it up. Andrew, when you're ready, we can open it up to some questions.
Fantastic.
Casey,
Well,
go ahead.
I just know there's a lot of seasoned lenders on the phone that understand all this, and I think it's just a matter of making the decision: are you going to do it now or do it later? Because doing it now gives you the opportunity to make money now and be positioned, or you'll do it later when revenues go down and you need to not only have one more product for your consumer, but also you need to have another product for your LO to sell, because it's you got to keep feeding the beast there too.
Right.
That's it. So I know you got a handful of questions. I see we're coming up on the hour. So we'll run over these last few questions quickly and let folks get back to the end of their month.